Hello and welcome back to another great segment with your boy Richard Williams, Asset Protector. I want to talk to you about financial literacy. We're going to call this Financial Literacy 101, keeping your credit game strong. So a lot of times we just willy-nilly and we're doing impulse spending, we're doing internet shopping on QVC, remember QVC, and the Home Network channel and Amazon and some of these different websites because of how we are feeling at the time. I just gotta have this scarf. I gotta have that hat. I gotta have these jeans. I just gotta have this cookware, things that you don't necessarily need to be spending. More than likely, we spend too much money buying things that we don't need, trying to impress people that don't even like us and that we don't even like. Why do we do it? Sometimes we buying things because we want to show off. Oh, I'm going to be so sharp when I walk in the room. I'm going to be the cleanest person in the room. Oftentimes, the cleanest person in the room, when it's not done right, is also the person who is the brokest. And what I mean is financially strapped because you're not being wise with your spending habits. Financial Literacy 101. Make sure that you hit that subscribe button, like, and share. Don't go nowhere. Sit right there because you might learn something. Or either you can take this information and share it with someone else that can grow from it. We're going to accomplish this financial literacy, keeping your credit game strong. We're going to accomplish that through three things today. Number one, budgeting basics. Budgeting basics. Number two, the power of investing. And number three, credit scores and debt management. These are three powerful tools that you need in your toolbox so that when you go in to the market, you're a lot stronger and you can stay there a lot longer. Number one, budgeting basics. So basically you need to save money and spend wisely. Now there is a difference in stingy and cheap versus frugal. Stingy and cheap is just that you don't want to spend money. You're cheap and you're afraid to spend money because you're operating from a place of lack. You don't know where your next money is going to come from, so you hold on to it. An old man told me something that made sense that may resonate with you. He told me this when I was a young boy, about 14 or 15 years old. And the old man told me, he said that you can take $100 in this hand and you take $100 in this hand. How much money do you have, son? I said, $200. He said, that's right. He said, but now think about it. You take that $200 in your hand and you don't let none in and you don't let none out. How much you got? $200, right? Still got $200. I can figure this thing out at 14 years old. I still got $200. But do you know what happens if you take a piece of paper and hold it in your hand long enough and you don't spend it, you don't let none in, you don't let none out of it, eventually it will dissolve, it comes to nothing. So one day you open your hands up and you won't have nothing in your hand but sweat. So where am I going with this? Growth does not mean taking everything and being stingy, stuffing it in your pocket, and being afraid to let loose of it. The best way to gain money is to let money go out and go to work for you. We'll talk more about that in just a moment. So you want to control your money and not let your money control you. When you spend too much money, what ends up happening is that your money will control you. Case in point, I just want to show you as we get wrapped up with this budgeting. So let's just say you have $3,000. This is what you have coming in as your income. Okay? You have $3,000 coming in for that particular month, or let's just say per month for income, right? So now with a budget, let me show you what you can do. You can take, let's say you have bills, right? You take $1,000 for your bills. Now I don't know what your bills are gonna be. More than likely your bills are gonna be more than $1,000. So don't lose it, okay? So now let's say you got $1,000 you put into your bills, and then you're gonna save some money, right? So let's just say you're going to save 500. We're going to call that SAV for savings, right? And then after that, let's say you're going to invest. And I'm just going to abbreviate INVEST. I'm going to abbreviate invest. And let's say you're going to put $500 towards investment. So when you add that all up, you're going to end up with, what's that, $1,000 that's going in. But you still have that extra $1,000 because you had $3. So now you still have $1,000 left over, right? Now, what can you do with that $1,000? You can go shopping. You can pay off some bills. You can pay down some debt. You can invest more than $500. Or you can just keep on saving your money for what they call a rainy day. I don't believe in rainy days. I like rainy days. Rainy days bring fortune. Rainy days brings abundance. If your crops don't get no rain on them, guess what? We don't eat. If it don't rain, the livestock can't eat, so we can't eat meat. So you can't go down to Gwynn, LA, and get your favorite steak, or if you like to go to Ruby Tuesday or Outback and get a steak, then you won't be able, to do that if there's a drought and there's no water. We always talk about rainy days because we like to speak about things that other people are saying and not really realizing how imperfect or how stupid. Let me stop searching for a better word, how stupid it sounds. You're saving for a rainy day. Rain it's like wealth. They talk about in the club, making it rain. What does that mean, making it rain? More money. The more water you get, the more things you can do. Right? If you own a beer brewery, you need to have water to brew the beer. If you own a soda company or a water company, or if you are on a laundromat, right? You own a car wash. So water brings a lot. Okay, it's not just like saving for a rainy day. You can't go outside because remember when you were kids, you went outside to play. I know I did. But then it's funny how you become an adult and then you don't want to go outside and play in the rain. I don't know. But those were the good old days. Okay, the next thing I want to talk about is the power of interest. The power of interest. Number one, as I've referred to this in a lot of my videos, is Einstein said, Albert Einstein, that compound interest is the eighth wonder of the world. And for those who understand it, they receive it. And for those who don't understand it, they're the ones that's paying it. Rich people are becoming richer as poorer people are becoming poorer. As you look at the disparity, the gap is ridiculous. The poor person comes, the rich person comes. And that's all in knowledge, is in what they know and they understand about compound interest. So you might work on your job, or maybe your mom and dad worked on their job and say, I've been working on my job for 40 years and I never took a day off. Well, guess what? While you were working, slaving on somebody else's job, what do you think the owner of that company was doing? The owner of that company was somewhere in Tahiti sipping on a Mai Tai, sipping on gin and juice. Now, rich people don't drink gin and juice. But drinking, living the life and being able to experience the beauty of what money can bring. So you want to start small, start early, right? Let's say, for example, you take a person that's 20 years old. I'm just going to put this on the board, 20 years old. 20-year-old person. It don't matter about your race. It don't matter about your ethnicity. It doesn't matter how strong you are. It doesn't matter how educated you are. It doesn't matter what family you were born into. This is money. It doesn't matter if you don't like black folks. That's fine. I don't know why a person wouldn't like me as good looking as I am, as fine as I am. I know it. I ain't got to wait for you to tell me. I know it because I got a mirror too. But imagine 20 years old, doesn't have anything to do with race. Forget all about all that stuff. This is the even playing field, right? You getting a job, you might be overqualified because you're black, right? You going for a job, you might not get the job because you're a female, right? You go in for a job and you might get the job because you're young and white and you're a male. This is just the reality that we live in. But numbers don't come with no type of sexual identity. It don't come with no race. It don't care if your pronoun is this, that, these, those, theirs, them, ours, he, she. It don't. The last time I knew what a pronoun was, I was probably in the 3rd grade. If I had to take a test right now with a college degree, and that's it hanging on the wall right there, I can't tell you what it is. But hey, that's not important. So let's say you're 20 years old, right? 20 years old, you're saving $100 a month. $100 per month, okay? Per month. Let me make that so nobody won't say Monday. $100 per month. And you do that. So 20 years, by the time, that's 40 years. 40 years. Now you're 60 years old. 60 years old. Let me tell you what this would be at 8%. So it's $100 a month at 8% interest. I'm just going to INT. 8% interest, we're looking at about $300,000 by the time you're 60 years old. So in 40 years, just at $100 a month. Now think about from the time you're 20 to the time that you are 60 years old, how much beer you gonna drink, how many shots you gonna take, how many females you gonna buy alcohol for in the club, how many pair of Jordans you gonna have, right? How many pair of Yeezys you gonna have, how many meals you gonna eat out at fast food restaurants or restaurants because you don't wanna cook, how much money you gonna loan to your so-called friends that are not gonna pay you back. Just think about that. You could take that $100 and for each month, instead of going out and wasting the money doing stupid stuff, because, right now, it's not stupid, you're 20, but going to the club, by the time you're 40 years old, you're going to look back and you're going to say it's stupid. A 20-year-old mind and a 50-year-old mind or a 60-year-old mind is two different mindsets, okay? So just think about if you're 30 years old now, and you're just starting out with that. That same thing, 30 years old, right? You're already 30 years old. So from the time you're 30, you're now, instead of 40 years, that's 30 years. And at 8%, because you're now at about 130 to 150K. That's all you are. Because you waited. See, that's the high cost of waiting. Don't wait. Don't delay. You don't have to understand everything and know everything. Understand enough to know that it works. You understand enough to know that you work like a dog on your job for your money. But what point do you let your money start working for you? At what point do you stop loving your money as much as you should love yourself and let your money go to work? Let your money, put on a necktie and a blazer, grab the briefcase, and go out and go to work and come back with even more money. So at this point, this is where you need to start thinking, okay, I'm young. And if you already past 20 years old, then you're already late. And most of the people that's watching this is over 18 years old, over 20 years old. I look at the numbers of who's watching, and I can see in the analytics, most of you who are watching, you're over 25 years old. In fact, most of the people that watch my videos are between the age of 25 to about 40 years old. That's mostly, and yet we talk about retirement on here all the time. And people who need this are the people who are not getting. But the people who need it the most are the people who stop doing what they're doing, inquire about it, look into it, and then take actionable steps. So at this point, you're 20 years old now, you're 25 or whatever you are, but I'm speaking to my 20-year-olds in this example. You do the math of how you need to do it to figure it out for your age, or reach out to me and I'll help you figure that out. When you're 20 years old now, you're saving $100 a month. By the time you're in retirement, you got yourself about $300K. Now, how do you make this more than $300K? Put more money in. It's simple. Instead of putting in $100, put in 150 some months. You know, maybe you get an income tax return, put in 1,000 or 300. Maybe you get a scratch off and you win $400, put $300 in and then blow the other 100. I'm not telling you to save all your money. Go have some fun, blow it, because you might not even turn 60 years old. So spend some of your money. Don't wait to get 60 years old to spend your money. I'm not saying don't spend your money. I'm just saying it's a difference in frugal. There's a difference in cheap. Budget your money so that you can do stuff. Because when you budget your money, think about it. You got a whole $1,000. This is play money. You got $3,000. You paid your bills. You're saving $5 and investing $5. Shoot, maybe you could save $100 and invest. Invest $900. And then think about what this number will look like by the time you're 60 years old, if you do it that way. So now this is the time you should be thinking about opening up some type of high investment yielding account, right? Whether it's a money market account, whether it's a mutual fund, whether it's a Roth IRA or a traditional IRA, it doesn't matter. Now you already know what I'm going to say. Index universal life. Why? Because you have a death benefit, meaning you could leave money to your family whenever you die. You're insured. Not only leaving the money, because nobody's interested in hurrying up and dying to leave no money, but you have a death benefit to put you away, put you in the ground, and then you can pay all bills with that. So you have a death benefit. You also have what's called cash accumulation value, meaning that the contract accumulates cash while you're living, money that you could borrow from yourself. We call it infinite banking. They try to make it sound like it's so hard, but you're becoming your own banker. Because now you can borrow. You have liquidity. Your money is liquid. You can take that money out whenever you need to. It's not like an ATM when you plug it in the machine and put in your PIN number and it spits out cash. No, you just have to be more responsible, meaning that you will reach out to the insurance company a couple days before you need that money, and that money will be sitting in your bank account. No questions asked. You got tax benefits, right? So you got income tax, IRS, income revenue services tax code 7702, which means now you have tax breaks. Your money is not being taxed. You can borrow your money when you need it. If you want to open up a business, or if you want to purchase a new home, or you want to purchase a high dollar thing like a car, right? If you live in California, you might want to buy an expensive generator. And the best ones, I think they're north of $4,600, about $5,000 or more to get a nice generator. You can pull that out of here, right out of here. Pull it right out of here, okay? And then finally, I want to talk about credit scores and debt management, okay? When you pay your bills on time, you want to treat your credit score like your future self in life depends on it. And your future self in life will depend on it, okay? Pay your balances down. Use less than 30% of your credit. Less than 30% of your credit. Anything over 30% of your credit usage monthly is hurting you. What am I saying here? Let's say you have $1,000 worth of credit, right? Then you don't want to use no more than 30% of that credit and leave the other 70%. That's going to work in the balance. That's what's going to help you. And then if you have an emergency or some need, then you can pull that from that 70%. You can pull from that 70% if you need to. But just to let you know, over 30%, as long as you stay to the left of that line, you good. But when you cross over 30%, then it starts working against you. Okay? So, just to do a quick recap, we talked about budgeting basics, talked about saving your money and spending your money wisely. We also talked about the power of interest, the power of interest. So you want to get your interest by putting your money in, let the interest grow, build into more money, right? And then you have more money later on at the time that you need that, right? So compound interest. And then finally, your credit scores and debt management. Monitor your credit scores. If you pay your bills on time, use less than 30%, you'll be a lot better off. And then when you need something, you'll have that. Some of us like to live off our credit. I've been there, and trust and believe, it feels great no longer having to do that. It's a good feeling to know that I have money now that's coming in, money that's accruing and accumulating. One of the most stressful things is, let's say you got $3,000 coming in, but you got $4,000 going out. You can't keep up with it. Then you're talking about outpacing inflation. Forget about inflation. Let's just talk about being able to survive month to month in your home. You cannot do it. It's unfathomable. It's undoable. Don't be in that situation. Be in a healthy situation where you're putting your money out there, you're growing your money, and over time, you get the dividends off the money. So if this has helped you some, and I hope it has, be sure to subscribe, like, and share this information with somebody. But make sure that you subscribe so you can come back, and I can keep putting information out like this for you, not just for your entertainment purposes, but for educational purposes. Because when we know better, we do better. Okay? And so now we've learned something today. And so now tomorrow moving forward, we are going to do better. And one more thing that I forgot to mention, and I have to say this. When you get paid, whatever your payday is, the 1st and the 15th, if it's the 15th and the 31st, I don't know. It doesn't matter. Whatever it is, you remember why you're working. You're working because you want to condition yourself in life and to have a better life. If you're working on a job or running a business and you paying everybody else and you're not getting paid, that's the definition of a slave. Whether you like it or not, that's exactly what it is, and it's foolish. Why would you pay everybody else? You go to work and work like a dog, and you pay everyone else, and then you struggling, you ain't got nothing. You will never get out of that situation until you start skimming a little something off the top for yourself, and then invest your money. Don't take your money and go and get $100 hairdo, or get $700 micro braids, or go start your sister locks for $1,000. Don't do that. Take your money and invest your money in some type of growth vehicle so that it will give you more money for putting it in there, and then go get your hair done. You know, and anytime you get a lump sum of money in your hand, let's just say you got $10,000 in your hand, right? And you know, you can think of a lot of things you can do to improve your life. Paying off bills, paying down debt, you know, putting a down payment on a car, getting the mortgage caught up, getting the HOA fees, the homeowners association fees, getting those caught up, your student loan, whatever. Take $1,000 of that money for yourself and just say the hell with it and blow it. Don't take all of your money and pay bills, because in the end, you're the one that's doing the work, and you will feel a lot better if you get a reward, right? If your mortgage is due, I'm not telling you don't pay all your mortgage. Let's say you're getting $3,000 a month and your mortgage is $1,500 a month. Maybe pay $750 on this pay period and $750 on the next pay period, because you don't want to be what? House poor, house broke. Just because you live, a lot of people live in nice homes, but they're broke because they don't know how to manage their money. They're making good money, but they still living broke and paycheck to paycheck because they haven't learned how to budget. The power of budgeting. Budget, 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 budget. And when you budget, you'll realize that you have more money than you thought you had. You have more money than you need. What happens is impulse spending. I gotta have that sweater. I gotta have that scarf. Oh, I gotta have this coffee maker. My wife has one, espresso. I gotta have this espresso, right? And we have a very nice espresso. But you better believe she has her eyes on another espresso. I told her, Wes, let's wait and get another one later. Let's don't get one right now. This one does what it needs to do. Let's put some more money in the market. Whether it be Bitcoin, we buy Bitcoin. Whether it be an annuity, whether it be an IUL, whether it's a Roth IRA, whether it's a 401k, whatever it is, put your money in something that's going to yield. Now, you know what I say about a 401k. I'm not knocking a 401k if your boss, your employer, rather, has a 401k plan and they're matching you, then yeah, put about 5, 10, 15% of your money in there. But if you're not making that much money to start with, don't put all your money in there, because when you need that money from that 401k, they're going to ask you to jump through a lot of hoops. And you're going to be saying, well, this is my money. Why do I have to jump through these hoops? IUL does the same thing. And when you need your money, you're going to get your money. You're not going to have all those taxes. Now, you will have a death benefit. The death benefit will be what's in it, and that goes to whoever get it when you're dead. IUL, you can get cash out of the policy while you're living without dealing with the tax complications, without dealing with the high fees, and without having to tell somebody what you're going to do with your money.